Scott Wren, are you being shamed by any bulls?
Well, I tell you, Scott, we think 4,700 is where the market's going to be at the end of 2024. But as Mike said, between here and there, we think we're going to have a bumpy ride here. So we're expecting a recession. We're not expecting the Fed to cut rates. We think earnings estimates are too high. So for us, we want to fade this rally and look to pick up some stocks at lower levels.
But I mean, those who've been, urging to stay defensive, by and large part, are the ones who have missed this rally.
That's right. It's helped us. We've been overweight until, as a matter of fact, today we've been overweight in technology, which, at 28% of the market cap, that'll cover up a few mistakes on some other sectors. So we just cut that position today, and it has been tough in some of these other sectors, but we've been defensive. That's how we stand right now. We hold a little bit of cash and we hold more fixed income than we normally would, but we do not want to chase this rally, Scott.
You're not banking on a soft landing?
We're not banking on a soft landing. We have penciled in the second half of the year recession and really the first quarter of next year as well. So we're expecting the Fed to make a mistake, and a Fed mistake means we're going to have a recession, moderate one.
You're going to keep hearing this, Mike, until you don't?
Yeah. No, and I understand why.
Sure.
I mean, there have been enough the prerequisites of a recession that have lined up, and they've been flaring for a while. I do think the market loses patience with assuming that it's just a matter of time and it's going to be soon. I'm not saying we have anything like the atmospherics of the 1995 scenario, which was the ultimate soft landing, but there were similar aspects of it where something structurally was different about the labor market than we thought going into that episode. We thought unemployment couldn't go low as it did without sparking more inflation. Now, we've had much more inflation right now to deal with, but there seems to be something structural with the labor market that's keeping it from weakening too quickly. And then I don't know what to make of the apparent resilient profitability, at least at the index level, because that's another thing that's gone on. For a few months now, the forward estimates have been climbing. So you hear B of A say, yeah, the market looks expensive at 20 times earnings, 20 times trailing earnings, but that's where they trade off trough earnings. That's just how it is in every cycle. So if we've just had an earnings trough, I know that's a lot to kind of take for granted, but I think it's the market's kind of suggesting that it's willing to migrate over to that being a higher probability outcome than we thought before.
Hey, Scott, how about that? What about the prospects of a different labor market and then the power of AI, which none of us really thought about in terms of the potential of being an earnings driver until 6 months ago?
Well, that's the thing that's really kept us out of a recession is the labor market and consumer spending. But if you look at you go back 40 or 50 years and you look at what happened before recessions, unemployment's always pretty low. And one of the things that usually goes along with that is that inflation is high and the Fed gets nervous. So, for us, that was a great CPI number, a little bit below expectations today at 4% for the year over year. But let's face it, the Fed is not going to be satisfied with that. We think inflation will be below 3% by the end of the year.